Morning, Market Chameleons. Happy Thursday. Soon to appear, the King Chameleon, Dimitri Pargamonic. How you doing, Dima?
Pretty good, Will. How are you?
Well, other than the half hour of technical difficulties, just getting this computer up and running, it's a good day. It's sunny out, and I'm interested to hear what's going on with the fast cash burn rate. But before we get started,
Yep.
let's get the disclaimer through.
Yep. Good morning. Oops. Good morning, everyone. And before we get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, call your broker. They could, help provide you with guidance, answer your questions. That's what they're there for. There's
All right.
the disclaimer.
So, what are you seeing in the pre-market? Anything?
We'll take a quick look at the pre-market report. And since we spent almost the entire day yesterday on it, I'm not going to spend too much time on it today, just so we could go and look at the new report that we did launch like about a week ago. We made some upgrades overnight, so it's going to look different today. I wanted to spend time on that. It's the fast cash burn rate report. So, unless you have any questions, I'm going to kind of go through this quickly and then jump to that report. Okay. So this is the pre-market report. Stocks trading in the pre-market hours. We have the most active stocks, biggest percentage gainers, biggest percentage decliners. I'm going to go take a look first to see what's going on in the higher market cap stocks. I'm going to use this filter and filter out stocks that have a $20 billion market cap or higher. So we got 14 that made the percentage gainers list, 14 on percentage decliners list. From that perspective, looks like a neutral opening. Some of the ones at the top, I see Wayfair up 5.5%, 111,000 shares trading hands in the pre-market hours. I'm going to go to these little alerts. This little E means that it reported earnings either yesterday after the market closed or today before the market opened. So it's probably reacting to that earnings event and whatever the management is saying if they're having a conference call. So you could see here, we got a bunch of E's today. So a lot of these are now reacting to their earnings. Same thing on the downside. We have a bunch of stocks here that are down, are reacting to earnings. I'm not going to go too much into this just to get more time on the new report, unless you have questions, Will, on anything in the pre-market.
No, let's get to that new report.
Okay, so let's skip down to this fast cash burn rate report. So it's under stocks. I'm going to come down here, and it's right here, fast cash burn rate. If you were using this in the last week, you're going to see a lot of changes today. We did this overnight. I think we enhanced it just to improve the screener and be able to narrow down the candidates a little bit further. Okay, so I'm going to kind of come down here. We'll talk about what these data elements are and what the objective is here. So a lot of people, usually we take things from the bullish side, right? We look for bull markets or bullish ideas, and that's what you really tend to do most of the time. But we do get a request, well, what about, bearish ideas or things that don't, stocks that look like they're in a bearish trend or heading lower? And there are different perspectives, ways to look at it. And this is one screener to find potential candidates, either stocks that are either bearish or have some underlying risk beneath them. And I'll explain that a little bit more, where they could be in a bullish trend, but if something happens, there's a lot of air below, not a lot of support. So the premise of it is this. Let's first read these data elements and I'll talk about it. So here, this is the unfiltered report. And we have Boeing over here. This is last price, what it did yesterday, market cap 133 billion. So the first condition to be a candidate on this report is it looks at a company's cash flow from operations, right? So this is cash flow it's generating from its normal day-to-day business. And it takes the last 4 quarters. And if in each of those 4 quarters, they were generating negative cash flow, in other words, their business, anything that's coming from their core business is just not profitable. They're just burning cash, right? So if it costs you $1 to make some product, and after you sold the product, you're losing $1, 10 cents or whatever you're losing, that is a little bit concerning, right? Because it's not sustainable over the long term. So it's looking for the last 4 quarters, cash flow from continuing operations. And if in all 4 of the last quarters, the cash flow was negative, then that stock is included in this report. Does that make sense so far to everybody? If there are any questions, let me know. But if there are questions, I'll go to the cash flow statement and show you what I mean. After looking at the cash flow in the last 4 quarters, we sum it up, 4 quarters divided by 12, and see what the average monthly burn rate is. So here in Boeing, it happened to be $1 billion per month, right? So if we averaged out last 4 quarters, they're burning $1 billion per month on average. Well, how much cash did they have on the books, right? That's the next question. So here they reported they have 7.1 billion on the books. So this is rounded, this is just rounded. These numbers are rounded, but given the amount of cash they have on the books, average monthly burn rate, then we just calculate what is the monthly, how many months do they have left before they run out of cash. So that's the idea. If they don't have a lot of months left, something's got to change, right? They need to raise cash to continue operating, to continue paying their employees, to continue, turning on the lights, to continue paying their rent. They're going to need cash from somewhere. So either their cash flow is going to change. They're going to either they have to start making profits, or they're going to have to tap into the markets and raise more capital. And that's either going to be done through, issuing more stock, which is going to dilute the shareholders, right? You're pushing more stock out in the market, or you're going to issue bonds and borrow in the debt market. But somewhere you got to get the cash if you're running out. So this is the beginning of the report. What we added to it was shareholders' equity. Now, and this happens to be negative, I added the shareholders' equity to say, okay, what is based on the books, what is their liquidation value? What do they think if they close the business down? What do they think after they sell all their assets, pay all their debt back, what's left over? Well, that's the shareholder equity. So we could compare that to the market cap just to see how far away it is. Because if the market cap is already below the shareholder equity, there might not be that much down. It probably, the stock was already hit far enough. It's already below its liquidation value. So you kind of want to see, well, how far away we are. And these numbers, sometimes they're subjective. They put that on their books, but they're intangible assets that could be worth more. This is just kind of like a benchmark that they're reporting. But even these, it's not like they're not always like a hard asset that like a stock where there's a mark and you know exactly what it's worth at that moment. They're like, they have intellectual property, their patents, whatever, that you might not be able to really price to put in there. So this sometimes could be overestimated or underestimated. But this is the number that they're reporting. So now that we have, their runway, we could see how long can they last if nothing changes. If their business doesn't change, how long can they last at this current rate? We also have a technical indicator here. And why is it technical indicator? Sometimes a stock can burn cash, and it doesn't mean it's necessarily a bad stock as long as they're making some investments in the short term that's going to pay off, right? Or there might be a legitimate reason. And I'm going to come down here for Carnival, right? So we see that Carnival is generating negative cash flow. They're losing money month to month, right? You could see that they have like 13 and a half months if they continue losing money. But we know what the problem is with Carnival. It's not their business model. It's because they're not allowed, their ships are not allowed to sail, right? They're standing because of the coronavirus. Their ships are, standing there. Their business model could still be good, but they need to start operating. They need to let the ships start going. They need to start getting back into business. So in this situation, we already know what the problem is, and it could be corrected as long as their ships are allowed to sail. So that's one way of looking at it. The other way is sometimes there could be an issue with the company, but that doesn't necessarily mean that the stock will start going down. Sometimes the stock will just go up because people are just buying it. And we've seen that a lot of times, right? Well, where things could be irrational for a very long time. So we added a technical indicator here, which is looking at the moving averages. And what this is doing is kind of saying, okay, if these things look weak, their financials look weak, and the stock is behaving in a weak manner, right? That's kind of like the market is starting to confirm what the numbers are saying. So the stock is behaving in a way that's confirming that these numbers are there, and that's why we added this technical indicator. All right. The other thing we added was average option volume. So why did we add this? If you're looking at a stock and you're looking at a potential short, you're, at least for me, from my side, I'd want to know, are there options? Because one thing is options sometimes can tell us and paint us a story as well. But if you're going to short it, you might just want to do the puts, right? Because if you're just buying puts or a put spread or selling a call spread, you're limiting your risk. When you're shorting the stock, you have unlimited risk, and you don't know what could happen, or you might not know the full story.
Yeah,
and
you could be right and go out of business really fast.
You could be right. You could be right, but go out of business before you're right, because the stock will rip in your face for a very long time until you lose, until you can't hold out, you cover, and then eventually it'll go down. And we've seen that before, right? During the financial crisis, we've seen it with like Fannie Mae and Freddie Mac. People just kept, there are signs that there's trouble. They were not complying with the New York Stock Exchange. They didn't even know if they were making money, losing money. It got so bad, nobody understood their books. But their two hedge funds kept pumping it up. They kept moving higher and higher, even in the face of this. So for a long time, until it finally collapsed. So if we're looking at, short ways to look at it to the downside, I think that the options are better because you could do it with limited risk, right? You could limit your risk in case you're wrong and it reverses. And then we got the IV rec. So this is the general idea of these data elements. So let's look and do a screen. Now, I want to mention another thing. The first time we did this screen, this is a new feature. This is a new report. I think the one that we screened out was CCXI. So this was a biotech that we identified as a weak one. It was on a downtrend. It did not have, a very long runway. And this stock did happen. And there's bad news that came out of it. And after that, it was down 25%. So the point I want to make here, though, is that by screening, we didn't know actually that it was going to go down, because there's no way of knowing if it's going to go down or win. It happened to have bad news, and the stock was down 25%. What we were looking for is the following. Because there's not a lot of support underneath, right? Because they have this issue where they're burning money, they have to find it somewhere. Because they have this issue, a negative report is going to have potentially a much bigger magnitude of the move than we usually see. That's why it was down. It was down 25%, but it shouldn't be surprising because we could see there's not a lot of fundamentals supporting it to hold it, because some stocks you could be wrong, you could even miss, maybe Apple misses earnings, or maybe it says, hey, we're not going to have a great quarter, but we shouldn't see it go down 25% because that wouldn't be catastrophic. But to some companies, even slight bad news can be catastrophic because they just don't have a strong fundamentals underneath it to hold it up. Does that make sense?
Yeah, that makes a lot of sense. We
Okay.
do have some questions. I don't know if you want to take them or wait.
Yeah, I'll take the questions.
Well, they all revolve around Boeing, which so funnily says Boeing has a real short runway, which is funny because they manufacture airplanes, I guess. But
yeah.
it looks like Boeing is less than 5 months of cash. Is that correct?
Yeah, and look, Boeing might. That's the thing. You have to kind of take a look at it and see what else is going on, because Boeing underneath it may actually have a free put, right? They could go to the government and get money. I think Boeing might be a candidate for like some bailout money, or they might be getting free money from the government.
Well, that's what one of our newest chameleons in the chat, Mo, said. He's like, you got to watch out. They may have a lot of access to PPE loans. So
exactly,
that's what he's saying. Yeah.
Yeah. So Boeing could be in that situation where, okay, this looks bad, but when you have the backing of, the government and taxpayers, they're like, well, we're not letting you go out of business. That changes the picture, right? Because that might not be available. Maybe it's available to some of these, even some of these cruise ships. I heard that they're getting some bailout, but it won't be available to these other stocks, right? It's not available.
Probably not the same for Carvana, right? Which has 6.5 months less. That's CNVA or CVN.
Yeah, exactly. So this report only shows you some, you can't paint the entire picture. You got to go do your research because there's so many different factors that can play into it. You're just it's like a starting point, right? Well, what's going on here, and you're trying to figure it out and to see, yes, this is, this stock's way overvalued. There's nothing underneath. There's nobody bailing it out, like Carnival Cruise Lines. Like I said, maybe once they start letting the ships run, they could return that could change, right? They could return to profitability. And they do have, look, this is their average monthly burn rate and this is their cash balance. But I don't know if they have access to lines of credits that they've already worked out, because they might already have some lines of credits with banks arranged that if they need more, they'll get more until they start operations, until they start getting back online. Now you have to take a look at all this.
The question I with Boeing, in shareholder equity, it's a minus 18 billion. Does that mean that there's so much more debt already on the books that they're actually negative equity in the company?
Yeah. So what, at least based on the balance sheets, okay, based on what they're reporting on the balance sheet, and I could go to Boeing right now. So I'm going to go here to Boeing. Based on what they're reporting, what they could have said is we have this much debt and we have this much total assets. So if their asset, because the debt, the only way to go down is you got to pay back, but the assets could go down in value, right? So your assets could say, hey, you know what? At one point our assets were worth this much, but now those assets are generating less cash, so we got to write them down, right? So here, I'm on Boeing. This is the cash flow statement over here. We're on the quarterly cash flow statement. And we're going to take a look at, I'm going to look at the quarterly, okay? So there's 3 different cash flows. There's one, it's coming from your operating cash flow. This is cash flow from your core business. Another is investing cash flow. So this is cash flow if you made other types of investments not related to your core business, you know, necessarily. Like you could have, you know, they could have bought Bitcoin, or they could have bought stock in Facebook, or they could have bought treasuries. And if they're making money in those, it's not coming from their core business, but it is cash flow. Okay. And then you got financing cash flow. And financing cash flow is if you sold stock, you received cash. If you bought your stock back, you're paying cash. If you sold bonds, you received cash. But that's not part of your operating business, but it's on your cash flow statement. So we're looking for this cash flow coming from your operating. It's cash flow from continuing operating activities. That's what we're looking for. And you could see 4 quarters in a row, it's down. So that's why it made the list, at least 4 quarters in a row. So if we added all those up, divided by 12, you could see it's, you know, over $1 billion. On a monthly basis, they're burning over $1 billion so far. The balance sheet will show, okay, you know, so here's their cash flow, you know, ending 7.1 billion. So you could see here it's been dropping 20 billion. Now they have 10.6 billion on the books, 7.8 billion, 7.1 billion. It's not sustainable, but they might have access to more cash, like we talked about. Their balance sheet, well, can they sell assets? You know, they could, you know, can they sell assets to raise money? Can they, you know, can they borrow against assets? So here they're reporting total assets, 150 billion. Okay. So they got current assets and non-current assets. So these are assets that are convertible to cash pretty quickly, you know, within a year. Then you got total liabilities. So if you have $150 billion in assets, but you have $167.9 billion, you know, in debt, you know, and then I think these are also rounded, but what they're reporting is they're in the negative. They have more debt than they have assets. Does that make sense?
Definitely.
Right. So we're looking at these numbers and saying, okay, there's not a great case, at least for Boeing right now from the fundamental perspective. And right now, like the stock has entered into a fast bearish crossover. So let's do a filter here. Okay, I'm going to filter some out because we've got 804 stocks here.
Hey, D, we had another question. Well, 2 questions to think about. I know we only have 8 minutes left. Gene was asking, how do we know if it's a high or low burn rate? Like, is it a history? How do you make that decision?
Well, you have the numbers in front of you, right? So what do you have is you have the monthly burn rate and you have the cash, right? That's available. So this tells us how many months you have left, right? Until you run out of cash. So if you don't have a lot of months, you're going pretty fast. Here's an Uber. Uber right now is burning $230 million per month, but they have $7.4 billion. So that's 32 months. You know, that's more than 2 years. You know, you're between 2 and 3 years. You could continue doing this. So they have enough time to potentially just turn that around and make it profitable, right? But this is telling you something here when you're seeing low numbers, something's got to change. You got to get money from somewhere. If you're not going to, either you got to start turning profitable or you're going to have to raise money because it's not sustainable, right? You need to pay your bills to continue operations. Because if you stop paying your rent and you stop paying all your employees and you stop paying, you know, your manufacturer, whatever it is, you're going to go out of business. So that's the problem. That's why we're calculating how many months are left, you know, until you have to do something. So the urgency is the smaller your runway, the bigger the urgency is. You got to change something or get money from somewhere. And they might be able to get money from somewhere, but if they, for example, they could issue more stock, right? You could go and sell more stock, secondary offering, but that has the effect of diluting the existing shareholders, because now the existing shareholders, you went from 1 million shares outstanding to maybe 1.1 million shares outstanding. You see what I mean? So now you're dividing your profits by the profits are now divisible by more shareholders. Okay.
And you see a bunch of those I know Boeing also has a negative effect from one of its main products, but most of those have been affected by the lockdown. Uber, Lyft, Carnival, RCL,
Yeah, right.
that's Expedia.
Exactly. That's why you got to take all that into consideration. So let's do this. I'm going to look for stocks with a price, let's say above 25 bucks.
AD, we had one last question that's come up a lot of times, is the IV rank. They wonder what type of, what do you place on the IV rank? How do you look at that when looking at these?
So there are two ways to look at it. Okay. One is that if you're looking for potential short play, and sometimes you might just do that because you have a lot of longs in the market and you want to offset it by some shorts, right? It's kind of like you're trying to offset some of that systemic market risk. So there are two ways to look at it. One is it's a low IV rank, could be, I think this potentially, if the market turns this one, these could, the magnitude of the move to the downside in these could be much greater than other stocks, right? So you might be looking at a low IV rank to see if you could potentially accumulate some downside hedge at a relatively cheap premium, right? So that's the IV rank. That's one way to look at it. The other way to look at it is if it's at a high IV rank in bearish, and in a bearish, like a downtrend, and so you might be in the midst of that sell-off already, right? That might be like it's already going down, and you're looking at something that's potentially happening now. That this is going down, and it might continue to go down. So those are just reference points depending on what your objective is. A lot of people who are long stock also look for short plays to offset systemic risk. Some people just look for short plays. And the thing with shorts is sometimes it's better to be getting short in the midst of the crisis than waiting for it to happen, because waiting for it to happen could be a very long time.
Well, I look at the one that jumps out at me is Carvana, right? But you look, it's in an uptrend. So that could continue until that turns. It could run you over for months, years, who knows,
It could be going up and up and up until until everybody gives up, right? And then it'll just turn back around. So that's the problem. That's why, you kind of that's why we put these in there, the technical indicators, just to show you what's been going on in the stock. So I'm going to use a couple more filters here. Stock price. We could look at a technical indicator. So we have uptrend, downtrend, bullish, bearish, crossover, fast bullish, fast bear. So I'm going to put any bearish technical indicator, So any bearish could be a bearish crossover, could be in a technical downtrend. If you hover over it, I think it tells you, but it's different. A downtrend is just basically all the moving averages are crossed in a bearish manner. Bearish crossover, it could be like the 20-day moving average just crossed the 50-day moving average, not the 250-day moving average. So you could read more about it, but these are any bearish indicator. I'm going to say has options. Let's look for a runway, I don't know, less than a year, right? So less than 12 months. So narrowed it down to 14. Let's look for average option volume above 1,000. So now I got 6 of them left. So here, I got IOVI, ED IT, DMTK, NVTA, LYFT, Boeing. And look here, right now, LYFT is in a bearish crossover, was down 6.3%, not a high IV rank. It could be one, we could go to it really quickly. I'm going to go to the options chain. We only have a minute left, but I'll just take a look at it from an options chain. And let's say I'm not saying LYFT is a bad company. I like the company. I use it. So nothing bad about this company. I'm just looking at it right now from just data.
You're just taking the data and looking at
the data right now and seeing what it. So I'm here in the. Oh, by the way, we did also update this yesterday, but I'm not gonna. I don't have time to get.
Hey, D, it is open and bell. You just want to carry this over to tomorrow and look at LYFT tomorrow?
Yeah, let's just do that. We'll take a look at LYFT tomorrow and see how we would, look at the options chain, see if there are any opportunities.
Awesome. So everyone come back for that. Chameleons, please. D, great job. It's a webinar a day here at the Pre-Market Show. Awesome job.
All right. Thanks, everyone. Have a safe day. Have a good trading day. Hope to see you guys tomorrow.
Trade in peace, Chameleons. Have a great day. Bye-bye.